Greetings, everyone, and welcome to QX Institutional. I am Anaïs Frank, the founder of QualitaX, a technology company focused on DLT-based digital transformation in the financial sector. Today is Friday, August the 2nd, and the episode is brought to you by the teams at QualitaX, Bluechip, and RWA World. This is a monthly roundup covering the latest development in DLT and blockchain in finance, stablecoins, and real-world asset tokenization. Our partner, Bluechip, is an independent stablecoin rating agency, and our other partner, RWA World, is a technology-driven company specializing in real-world asset research and analysis. So let us jump straight in with part one, DLT and blockchain in finance. Schroders Capital and Hanover Re successfully piloted a tokenization project for insurance-linked securities investments. According to them, the pilot demonstrated that improved efficiency and transparency can be achieved. I quote, Stefan Roth, co-head of private debt and credit alternatives at Schroders Capital. The success of this pilot showcases the immense potential for enhancing transparency, streamlining investment processes, and improving client experience in the reinsurance sector. In other news, DekaBank issued a digital bearer bond without using a central securities depository as part of the ECB's wholesale DLT settlement trials. The bond was issued on the SWAT network. Apologies, I'm not sure how to pronounce this correctly. It is spelled SWIAT. So this is an institutional blockchain network funded by DekaBank, where LBBW and Standard Chartered's SC Ventures are also co-investors. Also part of the ECB trials, Clearstream, DekaBank, and DZ Bank successfully issued two 5 million euro tokenized bonds. This marks the first institutional-grade DLT issuances in Germany using wholesale digital central bank money. In other news, Hamilton Lane, managing over 900 billion USD in assets, launched its 550-something million senior credit opportunity fund on the Solana blockchain, offering accredited investors access to private credit with a 10% annualized yield. If you remember, last month we discussed how more and more financial institution asset management firms were releasing more products and offering on public permissionless networks, mostly focused on the Ethereum ecosystem. So this is a good example of institutional activity in the Solana ecosystem as well. Okay, moving on. JP Morgan revealed that Ant International has processed billions of dollars in transactions using GPM Coin's programmable payment features for internal treasury functions. Also, Ant International, this time with BNP Paribas, has formed a strategic partnership to enhance cross-border payment solutions and explore innovations in tokenized deposits for global treasury management. And finally, the CDP, Italy's Cassa Depositi e Prestiti, one of the main and oldest financial institutions in Italy, founded back in the 19th century, issued a 50 million euro digital bond on the Polygon network, leveraging Italy's new law allowing DLT for specific financial instruments. Meanwhile, State Street is exploring the creation of its own stablecoin and is currently engaging with regulators to understand and implement compliance requirements. Stables partnered with MasterCard to launch a virtual card for its new EuroPeg stablecoin in Europe, potentially accelerating stablecoin adoption in the European market. Last month, I announced that a case study implementation of the Enterprise Ethereum Alliance DLT interoperability specification would be released in July, and it was. So let us dive into it together. In June, Finality had a press release announcing Finality and HQLAX complete successful end-to-end testing of cross-chain intraday repo settlement. It states that the testing showcases a trade-to-settlement cycle of an intraday repo across the Finality Payment System, FNPS, and the HQLAX Digital Collateral Registry, which bridges the distributed ledger technologies DLT of Enterprise Ethereum and R3's Corda platform. So what does that mean exactly? First, a bit of simplified context for those who are not familiar with the topic. As you know, Banks have multiple transactions to settle throughout the day. They include payment to other banks, customers' withdrawals, transfer between accounts, etc. And banks must meet those payment obligations at the time they are due during the business day. The risk that they cannot meet those obligations is called intraday liquidity risk. Let us say I am Bank A, I need 50 million to settle payment today, and I'm expecting to receiving this amount, but I'm not too sure of the exact timing. I decide to temporarily sell securities, intraday repo, for 50 million in exchange for immediate cash. Basically, what that solution is enabling is for this to happen at a predetermined precise moment in time. More precisely, it enables intraday repo to be settled in real time using central bank-backed settlement tokens. So it is really a very good solution for managing intraday liquidity risk. And this is possible by leveraging the Enterprise Ethereum Alliance DLT interoperability specifications. And this is somewhere, if I put ASP, as you can see, the protocol used for the test is a Finality Atomic Settlement Protocol, ESP, which is based on the EA interoperability specifications. Okay, so with that context in mind, let me open the case study. Oh, why is it here? So those are the company here. We don't need to read this. Okay, case study. The context of the case study is a delivery versus payment DVP use case involving a basket of securities traded between two banks and settled via HQLAX, Finality International, and Adara, leveraging Corda and Ethereum DLT technologies. Basically, what we have the securities managed on the private permission Corda network, and the cash is managed on private permission Ethereum network. How does it work concretely? If you scroll down, okay. So we have Bank A and Bank B agreeing to settle the DVP trade off-chain. Then Bank A submit details of the trade to the DVP smart contract on the FNPS Ethereum network. If you remember, this is a cash network. Then Bank B also submits the trade details to the DVP contract on the FNPS Ethereum network. Then Bank B verifies the trade details and places the payment leg cash on hold for Bank A. This marks the DVP contract as notary on the cash network. Then we have HQLAX verifying the trade details and placing the delivery leg securities on hold for Bank B using a Corda transaction that is signed by Bank A and Bank B, the custodian and also a notary. Then HQLAX constructs an attestation proof of the delivery leg hold on the Corda network that is translated into a EEA compliant question function call, which is sent to the FNPS through Bank A. Then Bank A executes the payment. By this, it executes a cross-chain function call on the FNPS Ethereum network to execute the payment leg hold after successful verification of the proof. And then an event containing an EEA compliant cross-chain function call is emitted to execute the delivery leg hold. Bank A will then receive the cash on the FNPS network. HQLAX will then receive the payment event. Basically, how does it work? It requests an event attestation proof of the payment leg execution on the FNPS Ethereum network that is translated into an EA compliant question function call from the FNPS. Then HQLAX executes the delivery by executing a question function call on the Corda network after successful verification of the proof to execute the delivery leg hold. And then Bank B can finally receive the basket of security on the Corda network. And that is it in a nutshell. If you want more information, I will leave the link of the case study in the description box. Also, in August, we will publish another case study implementation of the specification, this time between Stellar Soroban and Polygon. If you are interested and you have not subscribed yet, subscribe so you can watch the roundup. In other news, the German Banking Industry Committee and the Federation of German Industries released the result of the proof of concept for the Commercial Bank Money Token CBMT project. So, who is involved and what is this project about? So, if we go to page 3, I believe participant includes bank, including Commerzbank, Deutsche Bank, DZ Bank, but also enterprises, L plus Mercedes-Benz, Siemens, and others. This group ran a POC for 7 months in order to, and it's actually written here, to demonstrate the technical feasibility of the CBMT and assess its potential to serve as a transformative force within the financial ecosystem. Functional use cases, including basic money transfers and advanced corporate payments, were investigated in 3 different environments. Certain aspects, such as compliance considerations, were marked out of scope. And apparently, the results of the proof of concept were quite positive. The POC has demonstrated that the CMBT has the potential to deliver meaningful benefits to industrial firms. It represents an important milestone in enabling on-chain payments using existing deposits, delivering new efficiencies, and paving the way for innovative products. So if we go to page 11, okay, here we have some background information. But what I want to show you is actually the design and principle behind the CBMT. Where is it? Page 11. All right, here. So as you can see here, the CBMT is designed to be multi-DLT. This means that there is support for different vendors or DLT solutions banks are already using, be it Hyperledger Besu, Corda, and private permission or public permission, etc. They also have the concept of color tokens. So basically, a color is assigned to the CBMT for each issuer to make it clear at all times which issuer is liable. But very important, all CBMTs, regardless of their colors, are all technically identical. And of course, we have programmable payment because this leverages smart contract technologies, and my understanding is that compliance is enforced at smart contract level, actually. And of course, technical service provider that support CBMT at a technological and operational level. So now let's look at the use cases. Where is it? Page 16. The proof of concept covered 3 different categories of use cases. One, pure money use cases. Then we have advanced corporate use cases. And finally, multi-currency use cases somewhere, I remember, here. So if you want to read more about the use cases and technical aspects, you can obviously read that. One thing that I've noticed is that the ERC 1400 standard was used in one of the POC. And we actually collaborated with DigiShare, Stallium, and other stakeholders to provide an industry deep dive report with case studies on ERC 1400. So this is on the QualitaX website. You can download the report and it's available here. So it takes some time, but it's quite in depth. So if you are interested in learning more about ERC 1400, I will leave the link in the description box. Okay, so to go back to the commercial bank money token proof of concept, let's look at the findings. Here, key findings. The result of the POC was that a commercial bank money token is actually viable and it offers considerable potential. The CBMT concept has proven to be effective in test environments, which underlines the stability of the testing technology for both basic and advanced transactional use cases. The report states that the CBMT could significantly expand the possibility for rule-based conditional transaction use cases. For example, it enables the implementation of complex business logic in transaction processes. It is expected that future improvements will have a significant impact on payment possibility and thus open up new innovative application scenarios. So what is the next phase for this initiative? It is one, to increase the number of participants, so bank, industry, enterprises, technology providers, and also to pilot or to do test pilots of a functional integration of the CBMT with existing system used by banks and industrial firms. So this is it in a nutshell for the commercial bank money token proof of concept results. And that is it on my side. We covered a lot in this first part of QX Institutional. Let us now discuss the latest news in the stablecoins market with Garrett Jones, Chief Economist Officer at Bluechip.
Welcome to Bluechip on Stablecoins, powered by Bluechip's weekly news roundup, posted every Monday on X at bluechip_org. I'm your host, Garrett Jones, Chief Economist at Bluechip. This week's 3 segments offer a news roundup, then some in-depth coverage of a recent ETHCC talk by Patrick Hansen of Circle, who offered some forecasts about the next few years in stables. And finally, we offer some highlights from Bluechip's twice-a-year State of Stablecoins report, which just came out last week. First, the news. CoinDesk reports that FINMA, the Swiss financial regulator, issued some guidance to its own banks, noting that stablecoin default guarantees pose risks to the issuing banks, to quote a headline from the CoinDesk coverage. The FINMA guidance explains how banks can limit the risks associated with guaranteeing stablecoin customers' deposits. Again, going from the CoinDesk coverage there. To me, what is most noteworthy about this is that privately provided deposit insurance of a sort is now being offered to stablecoin deposits in one of the world's most historically important financial systems. Some Swiss banks are now offering private forms of deposit insurance for stablecoin deposits. This is yet another signal of something we've been seeing over the last couple of years, a blurring of the lines between traditional finance and the world of crypto. And these deposit insurance processes, one should remember, are not government-backed here in Switzerland. That's part of what this story is here to let you know about. But private insurance is of some value to some depositors, and so people should keep that in mind, that if they're interested in privately provided stablecoin deposit insurance, a form of that is now available in Switzerland. Another story that comes from Bluechip's weekly news roundup is concerning Cantor Fitzgerald CEO announcing at Bitcoin 2024 that he's once again defending Tether. He's made statements about this before. I think the fact that he's reiterating it here in such a prominent setting is historically important. Regardless of what happens with Tether down the road, the fact that Cantor Fitzgerald CEO is willing to stake his name publicly on the quality of his relationship with Tether is, I think, important. There are many questions that many of you have about Tether, and the fact that Cantor Fitzgerald, an important bond trader that's been important in the global world of trading a form of guaranteed tradable securities, seems noteworthy. Perhaps the more important news for many of you from Bitcoin 2024 is that Donald Trump made quite a few statements about crypto generally. But in the world of stablecoins, he made this statement, and this is a direct quote. As part of our effort to provide regulatory clarity, we will create a framework to enable the safe, responsible expansion of stablecoins. Here I'm quoting from Bluechip's tweet, quoting the former president's speech. And what's noteworthy here is that stablecoins made it into a speech where a lot of people think that Bitcoin in the presidential debate is a story about risk, about volatility, perhaps about speculation. Here was a discussion of payment systems and something much more mundane and money-like. The presidential speeches during a campaign season, of course, are not official policy, and they're only a weak predictor of what happens in the future, but it is an important flag planted in the sand there. In other news covered in Bluechip's weekly news roundup, I think it's noteworthy that Coinbase Asset Management is planning to launch a tokenized money market fund. This again continues the expansion of money-like assets, money-like security projects being moved into the world of stablecoins. One world of fixed payments of safe, stable assets, what we think of as cash, and this more blurry world of treasury bills, short-term securities, is both of those sides are now being combined into the world of cryptocurrency through these stablecoin-like assets. So keep an eye on this. Tokenized money market funds are another expansion of money-like payment systems being moved into the world of stables. Many of you have kept an eye on what Societe Generale has been doing in the world of stablecoins. Their Forge project has moved forward, contrary to what a lot of people might have expected. To me, the real news here is that recently White & Case, which is an important white shoe, prestigious, historically important law firm in New York, served as an advisor to Societe Generale Forge's updates to its convertible stablecoin project to make it compliant with European MiCA regulations. I'm going to quote from the press release here, just so we know that what I'm covering here is their official position, which I think is itself newsworthy. So what they note here is that what they claim in their press release is that all capabilities of an open stablecoin are met. Compliance with the MiCA regulation, and here's what I think is the important phrase, free transferability without whitelisting restrictions. So we're talking about something like permissionless stablecoin usage on a wide variety of chains, not just on privately maintained blockchains. So, and in an interview that was posted on one of Societe Generale's blogs, the CEO of Societe Generale Forge, Jean-Marc Stenger, said, and this is again quoting his official statement, SJ Forge is strengthening its offering to crypto ecosystems while continuing to develop innovative cross-border settlement payments and payment solutions based on blockchain technology, and here again what is, I think, the important phrase, for its corporate and financial institution clients. I think this is another signal that Societe Generale sees stablecoins as not just a payment system for small players, but for large, as he says here, corporate and financial institution clients. The idea that stablecoins are expanding into corporate payment systems, into B2B and things related, that is, at least on paper, the statement here, consistent with the statement here from Societe Generale Forge. In our next segment, we'll discuss Patrick Hansen's remarks at ETHCC. Patrick Hansen is Senior Director for EU Strategy and Policy at Circle. In his 15-minute address, he offered some forecasts of what might happen in the world of stablecoins over the next couple of years. I don't see his forecast as something to just be believed outright, but rather to be treated as food for thought. Let's start with his first forecast. He mentioned that he thought that euro-denominated stablecoins will increase in market cap by 5x. Now, that's not too hard a forecast to make, since, as you know, euro-denominated stablecoins are a vanishingly small part of the stablecoin market. So a 5x increase is not too hard to imagine. But he offered some additional concrete information about the fact that Europeans tend to use fiat for their crypto on-ramps and off-ramps, whereas people in the US tend to use stablecoins as their on-ramp and off-ramp into the world of crypto. So that is a quite important difference. And I think it makes it that much easier to believe that there will be a 5x ramp up in just perhaps even a year or two, like he predicted. That's a quite reasonable forecast. His second forecast is that USDC will become the leading stablecoin in terms of overall liquidity and volume. Now, that might be a case of just talking his own book. We'll have to see whether that really happens in the future, whether he has any he didn't seem to offer any particular information about why that would tend to happen, but let's just wait and see. They're already quite a dominant force in the world, and perhaps that trend will continue. Also, he says that 3 to 4 leading trading platforms will emerge. That's not too hard to believe that that's what would happen in the world of crypto, because in many payment system settings, just a couple of platforms tend to win out. We're all familiar with Visa and MasterCard as payment systems, and we're familiar with the fact that when it comes to trading stocks or bonds, there are just a few markets in the world where the vast majority of the trades take place for a particular market. So that means that some smaller platforms will vanish, of course. He points that out. He also says that financial institutions will enter en masse. I'm already on to number 4 now. And he thinks that 5+ banks will launch stablecoins, and even more will provide crypto custody and exchange services. That, again, seems like a very safe prediction, I think, something in that ballpark. The fact that, as I noted before, Société Générale Forge has been able to create what apparently will be something like a permissionless stablecoin, something that does not require whitelisting for usage. That's quite transformational, I think, if it turns out to work that way in practice for sizable transaction volumes over, say, the next 6 months or so. Other banks will definitely pay attention to that and want to move into that realm. As we've mentioned before here, Nick Carter's view that stablecoins are the new Eurodollars does seem to have a lot of meat behind it. There is an unmet demand for dollar-based payment systems in countries where Eurodollars have not fully reached. And if Société Générale Forge has even a modicum of success over the next 6 months or so, other market participants in Europe and outside of Europe that are sophisticated regulated financial institutions will try to create projects that will take advantage of the power of stablecoins to work as Nick Carter points it out, crypto dollars. So we'll see how that happens. We'll end the second part of that. We'll also have to see how that works out. Number 5, he says many EU startups will be bought or vanish and the market will consolidate. He particularly mentions Bitstamp's acquisition by Robinhood as one example of this. I personally thought when he started talking about this that he was talking about stablecoins being consolidated. He didn't mention that as far as I noticed, but that could happen as well. But market consolidation through mergers is a friendlier way for consolidation to happen rather than crushing the competition. It's safe to predict that there will be some continual consolidation, both of trading platforms and perhaps of stablecoins as well. So one message there for people who are running crypto-related projects is that you should consider running it in a way that you are friendly for acquisition. That will make it easier rather than harder for someone to come in and acquire you at an attractive price. Number 6, a few leading crypto-related teams will move to the EU to benefit from regulatory certainty. That is certainly a possibility. So if there's one thing that large businesses like in particular, it's regulatory certainty. They don't want to get in trouble with their regulators, and they might locate themselves in a way so that they can move into the world of crypto in a way that will have the blessing of important financial regulators. That is certainly something. It's hard to say whether that's going to be a large part of the market, but it is safe to say that every large financial institution that's interested in moving into the world of stables in particular, which are so money-like, and since the world of money is so heavily regulated, that they will keep an eye on what's progress happening in the European market, and if that's moving forward without a lot of regulatory pressure from European monetary authorities, that will be an attractive venue for them. And then the final forecast is that 3+ fully regulated trading venues for tokenized securities will emerge and settle with stablecoins of some sort, more or less. That again also seems likely. If we've seen something in my coverage in Bluechip on stablecoins over the last couple of months, it's that tokenized securities, especially money-like tokenized securities, have been growing, not by leaps and bounds perhaps, but at a steady pace, and that sophisticated market participants have been involved in this, people who do keep an eye on what regulators are thinking. So I think that's a sign that fully regulated trading venues for tokenized securities are a reasonable forecast for the future. So overall, aside from number 2, which might be talking his own book, or perhaps he knows something we don't, these are fairly safe forecasts in general. And any list of 7 forecasts like this, 6 of which I'm willing to more or less agree with, maybe that means 4 of them really happen in real life, and you get to decide which 4. So let's keep an eye on this, and I hope that you found this to be useful food for thought. In our final segment, I'll discuss highlights from Bluechip's latest State of Stablecoins report, which is for the first half of 2024. The full report is available at X at our account at Bluechip_org. The first news I want to cover is the fact that stablecoin supply migrated to smaller chains to a small, perhaps moderate degree over the first half of the year. The top three chains, as this graph shows, lost a combined 5% in market share. The top three chains here being Ethereum, Tron, and BSC. And they lost a small amount of market share to the smaller chains. So there's a slight decompression, a slight deconcentration in the stablecoin market. And that's noteworthy. The second piece of information here is that yield-bearing stablecoins took market share. That'll be no surprise to those of you who've been keeping track of the world stablecoins through our monthly reports. And the report here breaks it down between those that offer it through yield derivatives or through outright interest or something very akin to interest. Many of you know that USDC Circle Coin now offers a form of interest. They don't call it that for legal reasons, and it is not legally structured as such. But from the point of view of a consumer, it works just like a sort of flexible floating rate interest rate payment. So yield-bearing stablecoins have taken market share, but again, look at the chart here. It just adds up to a few percent. If rates do stay high, if interest rates stay well above, say, 3% for quite some time, obviously that market share will increase as more and more users feel like they're missing out on something there. Our final piece of news here is that tokenized treasuries really did take off. Earlier, I sort of downplayed the skyrocketing increase in tokenized treasury bills, but to go from maybe a few tens of millions of dollars into well over $1.5 billion in such a short period of time, a year and a half, that in percentage terms, that's certainly skyrocketing, even though, of course, in the scope of the global size of the T-bill market, which is in the trillions of dollars, it's a very, very small percentage. So one can expect that if regulators do not put any brakes on this process, this will increase at massive rates for quite some time. $100 to $200 billion could easily be the steady state level here for where tokenized treasury bills take off as part of the market. There is, as I mentioned before, global demand for dollar-denominated liquid short-term securities, whether we call that money or T-bills. And if U.S. regulators and global regulators don't stand in the way of that, this is going to be a market that continues to increase. To economists, the money market includes checking accounts, currency, and short-term treasury securities. And T-bills are certainly part of the bailiwick of those of us who keep track of the dollar-denominated money market, which here is in percentage terms skyrocketing, in dollar terms just a drop in the bucket, and much and small compared to what it plausibly will be in just a couple of years. With that, let me close by thanking you once again for joining me for this month's edition of Bluechip on Stablecoins, powered by Bluechip's weekly news roundup, posted every Monday on X at Bluechip_org. As always, be prudent, have fun, and keep learning.
Hello, everybody, and welcome to another episode of QX Institutional. My name is Tyler Sherwin, Head of Business Development at RWA World, and I'm joined by Ray Buckton, our Head of Research at RWA World. How are you doing today, Ray?
I'm doing absolutely fantastic, Tyler, and I am super stoked to be digging into all the happenings for the month of July.
Yeah, we're really excited about some of the topics that we have to talk about today. We're going to be going over some institutional, regulatory, and ecosystem developments for the world of tokenization. But real quick for our audience, if you're not familiar with RWA World, we are a thesis-driven technology company focused exclusively on tokenized assets and RWAs. It's our mission to bring clarity and transparency to this market and help people make better decisions about their investments and research in the field of tokenized assets. So without further ado, I want to start off with a little bit of a feature, Ray, which is that we've been seeing a variety of predictions about the scope of tokenized assets. And in the month of July, which is the month we're going to specifically focus on for this particular segment, there was a new prediction about the size of the tokenized asset market cap by the year 2034. Standard Chartered, which is a research firm, published a prediction that they are anticipating over 30 trillion market capitalization for tokenized assets by the year 2034. And I'll just point out that this is something that we watch pretty closely at RWA World. As we see certain predictions, we tend to pay attention. The one that really kicked off the fervor for tokenized assets, I think, was in September of 2022 from Boston Consulting Group when they first predicted 16 trillion market cap. Soon thereafter, the next year in October, 21Co published a report saying that they were anticipating 10 trillion by 2030. And then McKinsey anticipated 2 trillion. And that was a report that just came out last month in June. Now, you can see there's these different predictions from different firms. And of course, they're all sort of asking the same question, which we ourselves are asking at RWA World, which is, what's the total value opportunity here for tokenized assets? What are your thoughts on this, Ray?
Yeah, 100%. So my first maybe I guess you could say minor concern was seeing this number shrink with every subsequent report from 16 to 10 to 2. It's like maybe it'll be 500 billion. Absolutely not. Now we're seeing Standard Chartered come out with 30 trillion, and what this suggests is it begs a really unique and interesting, distinctive question. And what that question is. Are we discussing new assets and new generation of wealth from assets that otherwise weren't in peer-to-peer or collective marketplaces? Or are we also talking about the overhauling of transactional plumbing? Because if we frame the question like that, we can begin to see that, okay, if we're talking about trade finance, as the Standard Chartered report highlights, they say that out of this 30 trillion, we can see between 3 and 5 trillion being specifically from trade finance opportunities. Then the opportunity becomes a lot larger, because ultimately most of the world's transactional plumbing runs on quite antiquated rails. Here in the US, it's a programming language called COBOL, dates back to the 1960s, one of my favorite statistics. So we're basically running on ancient technology. And if we can begin to tokenize these assets in a compliant means, then ultimately what that allows us to do is see this number inflate to very significant valuation. So we're seeing 30 trillion market cap for total tokenized assets by 2034, and I don't believe that we're going to go from 2 trillion to 30 trillion in a just 4-year time frame. So really, it's anyone's guess, and it's really anyone's gamut in terms of what this market size and scope actually looks like. But I want to underline the scope there. Are we talking about new assets coming on chain, or are we talking about the overhauling of the transactional plumbing? That's a very important, distinctive question, and we highlight that quite regularly at RWA World to try and frame and add more color and context to the discussion.
Yeah, and I think one of the important points is the speed of growth. One of the facts we'll be talking about later is that, treasury bills are growing faster than stablecoins, for example. And sometimes when you look at these reports, McKinsey's criticism of prior reports was that they felt that the growth from the time at which, let's say, the Boston Consulting report came out to the point in which they were writing the report, there wasn't enough growth during that time to justify maybe that 16 trillion number. But people need to remember that for existing assets that already are out there that are not yet on the blockchain, we would consider those to be counted in this market cap as soon as they go live. And that's literally the moment of flicking a switch, right, mm-hmm. Ray? So there's not this period of like they have to grow in size. The assets themselves already have a value. Treasury bills, real estate, they already have a value that is agreed upon outside of the blockchain ecosystem that they might now live on. And so when you then bring those assets to the blockchain, we anticipate that that's going to be a source of major growth for this market cap.
100%. It's like migrating let's say, video game assets to a new server. If you already have a $3 billion in-game economy and they open up a new server, let's say in St. Louis, it's not like that St. Louis server has to start from 0.0 and grow year over year. They just do an immediate migration to the new server, and it goes from 0 to 100 very, very quickly. And that's kind of what we're seeing here, potentially. Of course, 2034 is still 10 years out, so we got a little bit of time left before we actually see the writing on the wall and the actual numbers of the charts.
Yeah, and I noticed Standard Chartered added 4 years to the previous. So everyone's doing 2030. So they're like, well, let's just do 10 years out. So it is truly anybody's guess what this market might look like by that time. But I tend to lean more towards the bullish case because there are so many projects that aren't even being captured by some of these reports. And so we're doing our very best to try to stay on top of that for our audience. So why don't we get into some institutional developments while we're on the topic? I know that a couple of things that have been interesting for us, we publish these insights in our weekly newsletter every single week, which comes out on Friday. So if any of this is new to you, you can find that in our newsletter. But there's a couple of things that stuck out, and I wanted to ask you about them, Ray. So first is that Ant International has started to use JPM coin to process billions in payments. That was an impressive thing that I noticed from our newsletter. Circle then is now being the first global stablecoin issuer to comply with MiCA. You've been talking about MiCA a lot in the newsletter every single week, which you're writing. It's a tremendous value and a resource for people. I would encourage people to check it out. And then Goldman Sachs, who we've also talked about in the prior month's update from QX, they're eyeing several tokenization projects for institutional clients before the end of this year. So, I mean, what is your sense of institutional adoption of RWAs, stablecoins, et cetera, right now? It seems that July is a pretty exciting month from that perspective.
No, absolutely, and really, from Goldman Sachs' perspective, kind of working backwards, is the race is really on to give institutional clients and allocators the access to tokenized assets in ways that are not just novel in terms of, hey, it's a tokenized asset, it looks really cool, yay, we're excited to have it, it's on tokenized rails, and that makes it different somehow. Realistically, the transactional efficiencies that this tokenization kind of configuration enables for the underlying asset is huge. And Goldman Sachs is definitely not the type to just kind of throw something at the wall and see what sticks. Now, naturally, any kind of financial institution will have periods of experimentation, but the fact that they're releasing 3 of these for their institutional clients specifically shows that they've done their homework and done their research, and they're not just picking 3 out of a hat. They've really done some due diligence. So very excited that they've obviously been working on these in stealth mode, because if they're going live by the end of the year, we're quickly entering Q4 of 2024. So any day, week, or month now, we can see these things have their switch flipped, and institutions can begin to take access and custody of these tokenized assets. From Circle's perspective, MiCA is the first major digital asset regulation from a developed market. Hugely salient, hugely important, and particularly for stablecoins, it's very unique. And the reason being is because the MiCA laws have pretty stringent regulations on US dollar denominated stablecoins, but not so much for euro denominated stablecoins. So Circle going through these compliance steps to ensure that they are indeed compliant in the European Union and that jurisdiction is major. There was another French company that followed on their heels very shortly after. So it just goes to show that these major issuers are beginning to navigate the winding road of nascent compliance standards that are coming online, which is exciting to see. And Ant International, huge conglomerate, JPM Coin has seen over $1 trillion in transaction volume thus far, which is very exciting to see. This is part of the ongoing conversation between private versus public blockchains, who prefers what, and that's an emerging and ongoing conversation. Like I mentioned, BlackRock may have thrown $100 million in terms of their BUIDL fund onto the public network of Ethereum, but private networks as well for JPM Coin are really seeing their day in the sun. So it's an exciting time for tokenization for institutions.
Yeah, great summary there, Ray. And I think that seeing JPM coin come up in the news again is interesting, because I remember when that got a lot of attention a while back when it first came out, and a lot of people were poo-pooing it. So it's impressive to see it actually getting some pretty meaningful adoption, and those volumes are quite impressive. So why don't we also now talk about some regulatory developments? I think it's been interesting from the political perspective. This month has been very saturated with a lot of political talk. For instance, Donald Trump speaking at Bitcoin Nashville, questions about whether the Harris administration would embrace or reject crypto. We're still sort of waiting for an answer there. So I do feel that the theme of this section is that, it's going to take a while for political clarity and regulatory clarity to come. I don't anticipate we're going to get a lot of answers to some of these questions before the November election, but real quickly, I think a few of the things that stood out to me was the fact that the House was unable to override Biden's SEC veto, the Staff Accounting Bulletin 121, which was set to be repealed by a bipartisan bill, which was sent to the president's desk, and he did not sign it, in fact, vetoed it. So that was really disappointing. It didn't really surprise me to see that the overturning failed. You have to get a higher number of votes to overturn that. So that was disappointing news, unfortunately. I also know that China's digital currency is skyrocketing in terms of transactions. You had an interesting statistic talking about over 630% in 2023. So seeing, China, one of America's, big adversaries, embracing this digital currency is very fascinating to observe. And I can't help but wonder if our own government and regulators, politicians are observing this and taking notes. And then, of course, you highlight something very, very important here, which is that there are still no bank custodians amongst the 9 approved Ethereum ETFs. And just for our audience's benefit, this is similar to the story with the Bitcoin ETFs. What we mean by this is it seems like Coinbase is one of the major providers and custodians, along with, I think, Gemini and a few others, Anchorage, but no banks are allowed to be the qualified custodian that maintains the custody of the Ethereum that's held in custody for the ETFs. And this is a result of SAB 121 in the first bullet here. So it seems that we have, although progressed with the good news, congrats, Ethereum ETFs are now live. That's very exciting. It still seems that we're just not able to quite get to that next level of adoption, allowing some of the oldest and most trusted institutions to actually hold these digital assets on their balance sheet.
Mm-hmm. No, 110%. I mean, you hit the nail on the head. It reminds me of that old 80s song. And this is particularly salient for governments. You know, why don't they say what they mean, or mean what they say what they do? Because one thing does lead to another. Absolutely. And SAB 121, to your point, which the U.S. House failed to overturn, absolutely results in the fact that banks are immensely wary to take custody of any kind of digital asset, least of which includes ETFs. This would be a huge, huge treasure chest and probably a very viable and juicy kind of table stake for them to dig into in terms of fees and structure, however they want to ultimately do that. That's above my pay grade. But suffice it to say, they can't really do that ultimately because of SAB 121. So entities like Coinbase, Anchorage Digital, etc., they are having a field day because they are trust companies primarily, or entities that have various legal configurations that allow them to take custody of these assets, hold them for clients without having to have the banking kind of segment of their business hammered on by the SEC. So very good for some, not so good for others, but particularly not really good for diversification of the custody landscape. And that's something that's a big takeaway as well. Kind of threading back to China's digital RMB and the transactions just exploding in 2023 by 630%. Likely we will see even larger figures for 2024. This is an ongoing question as to the salience of central bank digital currencies, CBDCs. When we were in Nashville, Tyler, you and I were in Nashville, we got to hear Trump speak live. Fantastic speech, very interesting. Felt a bit like a campaign speech on a campaign trail, just one of the stops that he made rather than a crypto-centric speech. But I have to say, I have to give him a round of applause. He seemed to know what he was talking about when it comes to the industry. And ultimately he vowed there will be no CBDCs under his regime should he be elected. And this kind of is at odds a bit with the digital RMB because, well, digital RMB is very much a central bank digital currency, or at least very close to it. And so we've seen China paying individuals, paying contractors and laborers with the digital RMB, trying to entice people to utilize this. So it does beg the question of how much of this is being pushed from the top down, how much of this is organic adoption. Because recall last month, this was something in one of the newsletters, in the RWA World newsletters, which if you're reading and paying attention to those, you might recall. And if not, I highly encourage you to subscribe. Many workers were just simply taking their digital RMB and immediately selling it and depositing it into their bank for the physical, or at least depository equivalent for their bank's version. And everyone thought, well, do they hate digital RMB? Why are they doing this? Well, it's a simple reason. The digital RMB currently doesn't qualify for interest. They're not earning interest on their deposits. So they were able to rotate that into their traditional RMB, earn interest, no problem. So there's still some kinks to be worked out in terms of these kind of CBDC systems. But ultimately, I don't believe that's a question for the US if Trump gets elected, because he vowed that we're not going to have one of those. So very
it's an important
stuff.
lesson. I think it's an important lesson for people to understand the programmable dollar, when used by a regime, can enforce whatever sort of monetary policy they want. And is an example you just pointed out, not being eligible for interest. Can you imagine if the dollars you put in your bank account, depending on whether they were the CBDC or not, would be eligible or not eligible? I can envision all sorts of situations where, if the Federal Reserve wanted to encourage spending, they might put a negative interest rate on your dollars in your bank account to incentivize you to spend it. And so this is something that people need to be very mindful of. This is the programmability that's possible with blockchain and smart contract technology. And so I appreciate you bringing these updates to our audience, Ray, so we can stay on top of it. Let's jump into some ecosystem developments as well. I think there's been a few things that are very interesting to watch. I mean, the RWA space, when it comes to the DAO space and diversifying into RWAs, has been really interesting. Tokenized treasuries have been in the spotlight, of course. And there's also been some major funding announcements. Do you want to walk through each of these quickly for us, Ray?
Yeah, 110%. So just kind of tying everything up with a nice bow for the month of July. BlackRock's Biddle Fund, mentioned earlier in the conversation, they seeded the fund with $100 million. It's now past $500 million. And that supports Securitize CEO Carlos Domingo. He was saying that tokenized treasuries are growing faster than stablecoins. He did note that treasuries will always be a smaller subset of the stablecoin market in terms of overall size, but nevertheless, the velocity of growth and adoption is really something to see and something to watch out for. And ultimately, the groundwork is being laid for the institutions and entities that are going to be building the future of tokenization. And we saw Partoir, never sure if to use the French or the Anglo pronunciation. Either way, we'll roll with it. And I'm sure
it's good that you know both.
Either way, they can dry their tears if they're upset of how I pronounce it with their 60 million Series B round. And they're trying to transform clearing, settlement, and infrastructure worldwide. And that's a huge thing. We're kind of tethering back to the transactional plumbing comment that I made earlier. They're huge entities at work to overhaul the now 75-plus-year-old systems that essentially underpin the Western banking system. And so it's very encouraging to see that we may be able to leapfrog a generation or two of technology and ultimately allow for far greater transactional efficiencies. And that still may leave that looming question mark over the ultimate valuation and total number of trillions that this market will be. But the fact that all the reports we're seeing say trillion goes to show why Partoir is able to raise 60 million for its Series B. So congratulations to them and to BlackRock and to Securitize as well. They're doing great work in this space.
It seems that every month that goes by, we have multiple headlines that we're sharing about Securitize and BlackRock, and the RWA space continues to benefit from the major investment and incentives that they are putting together to encourage people to move assets on chain. One of the examples that's not here on the screen, but one that I thought was salient from this last month, is the fact that Arbitrum DAO diversified some of their treasury assets into tokenized treasuries. And just to highlight for our audience, this is a pretty interesting thing in development that we've seen happen now, where you have a on-chain organization, DAO, in this case Arbitrum, a layer 2 on Ethereum, that is wanting to have on-chain yield that is diversified and different from the crypto industry. And a great way to do that is with tokenized treasuries. And so we had a great conversation with the co-founder and COO of Superstate, Reed Cumming, and he was telling us about that fact where when working with Arbitrum, they're looking for a diversified yield that's sustainable, that comes from a source that's outside of the digital asset industry. And so as we observe this ecosystem growing and maturing, we start to see more and more themes, which are traditional asset managers providing solutions to a more crypto native crowd who are wanting to have that on-chain interoperable experience while benefiting from a sustainable source of yield that is uncorrelated to the digital asset industry. And I think that theme is just going to continue.
Absolutely. The ongoing interpolation of TradFi and DeFi, sometimes one walks closer to the other, but ultimately it seems that they're going to meet in the middle from a technological and user-centric perspective. So very encouraging to see.
Absolutely. And we'll be there to document it every step of the way. So I wanted to thank you, Ray, for sharing your insights with us. For those who are listening to our audience, we have this weekly newsletter that we publish a lot of these insights in. Ray runs that newsletter. It's a fantastic addition to your weekly digest. I would encourage you to take a look at it. If you're interested in learning more about a lot of the different RWA companies that we've listed here, we have a database, one of the largest in the industry, that has over 415 real-world asset companies that we have documented. You can sort them by blockchain, by the type of asset being tokenized. We want this to be a helpful resource for our audience. So I would encourage you to take a look at it. And also don't forget to subscribe to the RWA World newsletter, where we share these insights on a weekly basis. Ray, thanks so much for sharing your insights. And is there any last words you want to share with our audience before we go?
No, I think you tied it up with a nice bow. Thank you so much for listening. Absolute pleasure to bring this kind of information to you. Keep an eye out for the next one for the month of August. How fast this year is going, indeed.
I wonder what sort of predictions we'll see for the market cap in August. So thanks, Ray, for being here. And we hope you guys enjoyed this episode. We'll see you in the next episode of QX Institutional.